I'd like to welcome Jeff Rubin, an award-winning economist, energy trade and financial markets expert, and best-selling author to our show. Jeff was chief economist at CIBC World Markets for almost 2 decades, from 1992 to 2009, where he received 10 citations as Canada's top-ranked financial market economist. Since leaving CIBC, Jeff has become a public speaker, written several best-selling books. This past spring, he released his fifth book, A Map of the New Normal: How Inflation, War, and Sanctions Will Change Your World Forever. I want to welcome to our show, Jeff Rubin.
My
Hello, Jeff.
pleasure.
Thanks for joining our show.
My pleasure.
Excellent, excellent. And, as always, I like to have a general conversation, and it's not always where we get an economist on our show. So it's fantastic to have you, someone who is, I guess, an expert in trade at this point in time when all we seem to be talking about is trade between the United States and our country, Canada. So great to have you on. Thank you again. And I thought we'd start off by, talking generally speaking about the Canadian economy, and wanted to get your perspective on where we stand right now. There's so many moving parts for the Bank of Canada, and for our government and investors to consider. So many concerns: inflation, tariffs, interest rates, geopolitics. I guess my first question to you would be, at this point in time, what sort of grade would you give the Canadian economy? And how does that, I guess, rate, or in comparison to our neighbors to the south, what kind of grade would you give the US at this point in time?
Well, great. I guess maybe like a B. I think, we haven't yet seen the final numbers from last year, but it'll be around 2.5%, which isn't spectacular, but could be a lot worse. The latest month we've had a dip in GDP, but you wouldn't want to hang your hat on one monthly GDP number. But whatever grade you want to give it, it's going to be downgraded. And it's going to be downgraded quite significantly because exports to the United States is, 20, 25% of Canada's GDP. And, that's going to have a very material impact.
And so I guess obviously exports from us to them will be an issue with regards to tariffs. What about the U.S.? Will it have the same impact on them, or to a lesser extent an impact? And how has the U.S. economy fared? I know when we compare the two economies, obviously the U.S. has a much better growth numbers. Their economy seems to be doing a lot better, whether it's because of technology, whether it's because, well, for any reasons, perhaps interest rates. What do you see? How is their economy doing in comparison to ours?
Their economy is doing stronger than ours. Of course, going with that is inflation is a bit more of a concern there, and certainly very different postures between the Bank of Canada and the Federal Reserve Board. But that's looking backward. Let's look forward. Canada will retaliate, and so they should. But let's be perfectly clear here. We are going to lose in any protracted tariff war with the United States. And we're going to lose for one simple reason. Exports are about 3 times more important to the Canadian economy than they are to the US economy. And 3/4 of our exports are to the US. That's not to say that there won't be local pain in the US. For example, there's like around 15 states. Their number one trading partner is Ontario. Okay. But in the aggregate, nationally, the Canadian economy is a much more trade dependent economy than the US economy. So, in any protracted tariff war, there's going to be more damage in Canada than in the US. That's not to say that we shouldn't retaliate dollar for dollar, because this shouldn't just be a free ride for President Trump. But it is to say that, it's not a long run solution. Our problem is that our greatest asset, reliance on the largest and richest market in the world, has now become a major liability. And, we're going to have to take a page out of some of the countries that have been targeted by sanctions, like Russia and China, who have diversified their trade. And that's why they've been able to absorb these sanctions with relative ease. And that's what we've got to do. It's not something that we can do overnight, but the sooner we start, the better off we'll be.
Yeah, it's interesting. We definitely there's been a lot of talk about changing the way we I guess deal with the United States and perhaps diversifying, our trade a lot more. I guess my next question is, what can we do here in Canada to get things moving in a more of a positive direction? We see the economic data, we see, GDP growth. It hasn't been too high, kind of it's been running just above the flat line for a while. Is the answer just simply to continue to cut interest rates? I know the Bank of Canada has taken on an aggressive stance and just seems to be cutting rates at every meeting. Is it as simple as just keep cutting interest rates until they become stimulative?
Well, if we want to have a 50-cent Canadian dollar, they should just keep on doing what they're doing. It's been my experience 2 decades on Bay Street that when Canadian interest rates are below US interest rates, the Canadian dollar has only one direction to go. And if you look at interest rate differentials right now, I mean, if you want to compare the bank rate with the Fed funds, you're talking about, 3% versus over 4%. If you want to talk about a 10-year treasury, you're talking 4.5, 4.6 versus 3.3. If we keep this differentials, the Canadian dollar will continue to depreciate. We've already broken into the 68-cent range. That's a 20-year low, and there won't be any bottom. Now, if the grand plan here is let's have a 25% depreciation in the Canadian dollar to offset the 25% tariff that we expect Trump to impose, yes, that would be an offset. But, do we really want to have a 50-cent Canadian dollar? Because that's what a 25% depreciation in today's levels would imply.
Yeah, and I guess over the last year or so, I've definitely called into question Tiff Macklem and the Bank of Canada and what they've been doing. And you have to, I guess, question it, to raise rates 10 times or whatever it was in a short period, and now to cut rates just as quick. You know, are we wrong to perhaps question as, the thoughts of Tiff Macklem and what the Bank of Canada is doing? Do you think they're doing a good job and they're on the right path?
Well, not to get into the personalities, but bigger picture. The issue, as I write in my book, is the problem is no one knows what normal looks like in the bond market anymore. And that's a legacy of the pandemic. I mean, we had overnight rates at zero. We had 10-year government bond yields at 0.5%. By some account, the lowest long-term interest rates have been in recorded history. So is that the benchmark? Sure, we had a huge run up in interest rates from those absurdly low rates because the Tiff Macklems of the world were buying the Chrystia Freeland's bonds at ridiculously low yields and ridiculously high prices, and the same ditto for the Fed and the European Union. But that's the problem. No one really knows what normal is. I think this world that we're heading into is an inflationary world. And if it's an inflationary world, then I don't think today's interest rates reflect that. And it won't matter whether President Trump fires, the Fed chair. The bond market will decide unless Trump wants to start ramping up the printing presses and go back to quantitative easing. And I would argue that today's long-term interest rates are not well calibrated with the reality of where inflation is heading.
Let's turn now to the stock market. Obviously, we are a financial show, and a lot of people listen to us for tips or commentary on the stock market. Obviously, North American markets in particular. Many would say the valuations are stretched, right? That when you look at it on a PE multiple, things look stretched. It's quite expensive. Do you agree? And if you do not agree, or perhaps you do agree, but do you still see value anywhere in the markets? Obviously, the markets are being led by technology. Do you still see any value out there?
Well, what's the alternative? Buying, a government bond at below 3%. And, it's real easy for the stock market to do well when bond yields are plunging. It's a little more challenging to swim upstream against rising bond yields, and that would also include AI stocks. And I think that's the real challenge from the stock market, that I don't think the market yet recognizes what kind of comeback inflation's about to pose. And, when we got a yield curve, we had the longest inversion of the yield curve in history. We've got basically a flat yield curve if you look at sort of like a 10-year Government of Canada bond versus the overnight rate. That's not sustainable, in my opinion. And it doesn't matter what the Bank of Canada or the Federal Reserve Board does. We go back to a normal shaped yield curve, and you're looking at 100, 150 basis point rise in bond yields. Let's see how resilient the equity market will be swimming against that current.
You mentioned artificial intelligence. Do you think big cap tech is going to lead the way this year again? Obviously, we've had now 2 years in a row where big cap tech has led the way. In my
That's
opinion,
right.
we were
They
headed
have.
for a recession, and I think if not for AI and the talk of Chat GPT and everything around it, we probably would have been in a mild recession a few years ago. So, do you think tech is going to continue to lead?
Well, one thing about tech is America's supposed dominance isn't as great as we've been led to believe. And we saw that with NVIDIA, Deep Six, all of a sudden, Sika, all of a sudden a Chinese firm that can do this at a fraction of the cost. So there's that issue. And there's no question that of any aspect of the stock market, the one that has benefited the most from these, very low bond yields has been AI. But as I say, I'm skeptical that the curve is going to remain distorted as it is. I think we're going to see a steepening yield curve, and I think all of the stock market, but in particularly tech stocks, are going to find it a lot more difficult, as I say, swimming against the current.
Swimming against the current. Yeah, no, for sure. As I said off the top of the show, great to have you on now at this time being a trade expert. So let's turn to everyone's favorite topic these days, tariffs. I guess my question to you would be, wanted to ask you about the idea of tariffs, putting on tariffs. Uh, can they be successfully used? And, are they a great tool for negotiating?
Well, in this case, I have to agree with President Trump. They can be very effective. But let's understand what tariffs are going to do. They're going to reverse the trade-off that we made for decades through globalization, which was sacrificing middle-class factory jobs for low inflation, and consumers certainly benefited from that. Tariffs turn that around. They're already bringing back manufacturing jobs that we thought were gone forever. But everything that we're going to make here that we used to import from places like China is going to cost us a whole lot more, whether it's, a computer chip or a kettle or a car. So that's the trade-off that we're making. It's good news for the subject of my previous book, The Expendables, like the hollowed out middle class. They're coming back. It's bad news for inflation. So it really depends on what you think is more important. Now, President Trump has said for decades, actually, he's been against, globalization and the World Trade Organization's trading rules. And he's championing the American working class, and they will benefit. But not, the American working class will benefit, but American consumers will pay the price for that.
Interesting trade-off. Well, just the thought of tariffs, right, has caused our dollar to fall substantially. Obviously, the Bank of Canada keeps cutting interest rates, and you mentioned earlier in our interview about a weakening dollar. Do you think that a weakened dollar can't offset some of the tariff pressures that we're going to see, or does the dollar have to fall a lot more for that to be a factor?
Well, it can. I mean, one of the ways that China has responded to tariffs, and remember that Trump imposed these huge tariffs against China in his first term, was a depreciation of the yuan. So, yes, the Canadian dollar can offset. But, a 25% depreciation from today's levels to counter a 25% tariff would imply a 50-cent Canadian dollar. What are the inflationary implications of a 50-cent Canadian dollar, particularly at this time of year when so much of our fresh produce is imported from the United States? I think we would immediately see that in grocery prices and food inflation, and not to mention the cost of travel. And there's more than a few snowbirds in this country. So, yes, but we would be talking about the Canadian dollar needing to go into a realm that it's never gone before.
Yeah, it's you know, sad to see our dollar as low as it is, even today at in the 68-cent range. I guess last time we saw that was, I think, 2020, when COVID hit, and then prior to that, probably a little while. I want to turn to your book now, and you've written a number of great books in the past. I want to read out just some of the ideas and themes of your latest book, A Map of the New Normal. You talk about a changing world, the change in global trade after the pandemic, a rise in government deficits, new emerging order with the rise of sanctions, moving from offshoring to friendshoring, what that means, dealing with your friends versus your enemies, and the potential rise of the BRICS. So much in the book. There are so many great ideas and themes. I guess my question to you and everyone listening and watching, what made you write this book and put in all these ideas? And I guess what is the main takeaway for that you would want from the readers?
Well, I guess the main takeaway is it's tempting to think that, Donald Trump is a black swan. This is an aberration, and if we can ride out the next 4 years, we'll go back. There's no going back. Okay, there's the old world that now seems, way in the rearview mirror. It doesn't exist anymore. In fact, it didn't even exist under President Biden with sanctions. We're in a whole new reality. So, the world trading system of the last 30, 40 years that we were constantly told was the basis of our collective prosperity, it no longer exists. And this is a whole new normal.
Interesting, perhaps a bit of a scary message for
Oh, it is what it is. As I
many.
say,
Yeah.
like for American workers, this is a reprise that they never could have dreamt for. But, it's going to change the way our economy operates, and that's going to create winners, and that's going to create losers, just as the old world trading system did.
Yeah, and I guess my last question, what do you think about the comments from the president talking to the BRIC nations that if they don't use the US dollar, they're going to just be hit with 100% tariffs? Do you think that can actually work? Can he continue to I guess, scare or threaten these countries?
No, he can't. China is not Canada. Okay. They'll go bring it on. Now, the US has already lost its status as the world's petrol currency, a status that it enjoyed for over 50 years. And we can thank Biden's sanctions and the response of Russia and China and Saudi Arabia to that. But there's more at stake. The US, since World War II, has been the world's one and only reserve currency. Guess what? China has other ideas about that. And, I'm not saying that the US dollar is going to lose that status, but it's going to be challenged in a way that it hasn't since during the post-war period.
Jeff Rubin, award-winning economist, best-selling author. Thank you so much for being with us this afternoon. It's been a pleasure having you on and shedding some light on everything that's going on right now, the economy, what's happening between US and Canada. Much appreciated. Thank you so much.
My pleasure. Hope to be back again sometime.
Thank you.